Let's go back to basics. What exactly is money in DemocracyCraft? The Minecraft server, also known as DC, has an in-game currency called the DC dollar, which players can use to buy and sell things with other players. DC dollars enter the economy through a variety of means. For example, players could use the server's official store to purchase DC dollars with real-life money, paying $140 for 100,000 DemocracyCraft dollars at official exchange rates. However, most players don't actually buy their DC dollars from the official store, because there are far easier ways to get new money. Instead, most DC dollars are printed using two key methods. Firstly, the Federal Reserve Bank, the Fed, can print new money. That money is distributed throughout the economy using stimulus checks, government bonds, and loans to private banks. Secondly, players can print new money by simply voting for the server on Minecraft ranking websites, which requires nothing more than a few minutes of clicking buttons every day. The more votes that DemocracyCraft gets on these ranking websites, the higher it appears on their lists, which, in theory, attracts more players to join the server. With all of this money printing, however, there's a risk of introducing problems with inflation, which is when the purchasing power of the DC dollar decreases as players value it less and less. So this is where the Fed comes in. The Fed is a group of 5 players who are in charge of setting monetary policy to ensure that inflation doesn't get out of control, and on paper, it has a lot of powers to do this. It can set interest rates on how much money it pays commercial banks to store with it, it can adjust the amount of money players get from voting, and it can introduce money sinks where money is just simply deleted from the game. In CityRP, for instance, the in-game government is made to supply, as in discard from the game, 9 stacks of stone, deep slate, and concrete every month. If the government failed to do this on time, the central bank would fine the government a certain amount of money, forcefully taking money and resources out of the game. Historically, there was just one problem with the Fed's mandate of tackling inflation. It didn't actually know what the rate of inflation was. In July 2024, the governor of the Fed, Stoppers, announced that inflation remains untracked by the Fed, and as recently as January 2025, the governor said in an interview that the Fed didn't actually have the concrete numbers to work out the rate of inflation. So essentially, the Fed had been setting monetary policy completely blind, and its monetary policy had been to put the money printers on overdrive. In the latter half of 2024, it printed $800 worth of stimulus checks, $4,000 worth of banknotes, and $10,000 worth of short-term bonds paying at 5% interest a month. Between 2023 and 2024, the money supply increased by a staggering 47%, and that's on top of a 35% increase in the year before. At official exchange rates, 2024 alone saw the cash supply increase by over $45,000. The market, however, didn't actually value the influx of new money at that rate, so in practice there was an unofficial exchange rate, known as the real money trading rate. By charting the rates at which players traded DC dollars with items purchasable only with real-life money, it was calculated that the median rate of DC dollars to US dollars was around 2,500 DemocracyCraft dollars per DC dollar by January 2025. This meant that the real money trading market priced the 2024 cash injections to be at around 13,000 US dollars, although, as would be explained later, some traders have insisted that figure is still way too high. Concerns have previously been raised about the Fed's money printing. In March 2024, experts commissioned by the Fed concluded that the current system of voting rewards, where currency is minted to encourage Redmont citizens to vote, is unsustainable, as money is being minted at a significantly faster rate than the economy is growing. And its recommendations? Shut down the money printers, hike interest rates, and raise reserve requirements. The Fed did none of these. It slowed down the money printers for 4 months before accelerating them again after complaints about vote rewards being too low were made by players. The Fed and its predecessors hadn't exactly been clear why it pursued loose monetary policy for years on end, and it has led some players to express confusion over the Fed's decisions. One player, for example, said in an interview, "I'm not sure what the Fed's position is on inflation. Last I heard from the Fed governor, he said there was too much money, which doesn't entirely make sense to me when he then gave away 20,000 DemocracyCraft dollars of stimulus checks to every player." This was concerning on 2 fronts. Firstly, the person being interviewed wasn't just some random person. It was Technofeed, who, at the time of interview, was the finance minister. If anyone needed to know what was going on at the Fed, it would probably have been him. Secondly, the person being interviewed was also a member of the Fed's Board of Governors. He was literally one of the 5 people tasked with drafting and voting on the Fed's monetary policy in the first place. One thing we do know is that the Fed, without access to much data, has been particularly reliant on the Consumer Price Index, the CPI, which the Treasury publishes every month. Indeed, if you mapped the monthly percent change in the median price of consumer goods, the CPI indicated that 2024 saw prolonged periods of deflation. But even this graph shows one of the key flaws of the CPI. It's incredibly volatile. To understand why, we first need to understand how the CPI was calculated. The CPI tracked sales in chest shops, essentially vending machines in Minecraft. Owners that wished to sell their items would place them in a modified chest, and players that wished to purchase those items simply clicked on it. The purchaser would automatically receive their item, and the cash would automatically be transferred to the original owner's cash balance. This meant that the CPI had a major limitation. It only tracked a small subset of consumer purchases. After all, not every player purchases things from a vending machine. Players buy real estate, company stocks, accountancy services, foreign currency, and cease and desist letters, things that would be very hard to fit inside a Minecraft chest. The relatively small size of the CPI dataset also meant that it was incredibly easy to manipulate. For example, between September and October 2024, the CPI suggested that the price of gold ingots increased by over 20,000%. According to 2 separate sources, this was caused by one player buying up as many gold ingots as they could to gamble it all away in a casino. What made the CPI even more unreliable was the fact that not every player actually used chest shops as vending machines. When a player purchased or sold things using a chest shop, the owner would obtain a record of that transaction. This ability to log things in-game has meant that some owners have used it to do just that, log things in-game. For example, the owner of a mining company may set up 2 chests, one to allow employees to buy a diamond pickaxe for $0 and another to sell a pickaxe for $0. This would do 2 things. Firstly, it would allow the employer to keep track of their company equipment, and secondly, it would completely contaminate the CPI data with thousands of transactions supposedly showing things being bought and sold for $0. In any case, even if we took the CPI data at its word, it's not entirely clear that it supports the conclusion of persistent deflation. If you mapped out the annual percent change, for example, the CPI doesn't indicate a deflationary trend. On the contrary, it suggests an average annualized inflation rate of 275% in 2024, peaking at a rate of over 1,000% in August. The Fed's decision to allow the gravy train of cheap money to plow on for years has caused the economy to become over-dependent on it. But the gravy train has already begun slowing down. The Fed has increased interest rates, lowered voting rewards, and reintroduced reserve requirements. If easy access to liquidity dries up, certain sectors of the economy could begin to suffer severe withdrawal symptoms. And one of those sectors could be the real estate market. One of the major beneficiaries of the Fed's monetary policies has been the real estate market, which has seen skyrocketing property prices over the past few months. Land in DemocracyCraft is limited, with the city of Redmont subdivided into various plots. Players can purchase these plots to build on them, and their buildings are automatically protected by the game from being destroyed by other players. There are multiple types of plots that players can own, such as residential plots, commercial plots, and farming plots, and each of these have their own rules on what can or can't be built on them. So why did players actually buy real estate? Broadly speaking, there were 3 reasons. Firstly, certain forms of real estate had practical functions. Residential properties gave players a space to store their chests, furnaces, and crafting tables. Commercial properties allowed business owners to set up chest shops to sell consumer goods, and farming plots allowed players to set up, farms. Some players bought real estate for entirely personal reasons, seeing virtual home ownership as an end goal in of itself. As one user pointed out, owning a house in Minecraft could help further immerse a player into the roleplay. They could, for example, host virtual watch parties of the US Super Bowl in their Minecraft homes. Yachts and skyscrapers, meanwhile, allowed wealthy players to show off how rich they were, a practice derisively described by one financial investor as nothing more than a dick measuring contest. But many sources across the real estate and construction sectors have indicated that the primary driver of real estate purchases had been speculative investment. As one business owner put it, I personally buy residential properties to store extra cash without scrutiny, basically as an illiquid asset. There is definitely a shortage of property in general, but nobody wants to sell, which leads to an increase in property prices. I also own multiple businesses, so keeping some money in a rising property market takes out some risk. And the property market, particularly commercial, had indeed risen. All across the city, commercial plots had seen substantial increases in the prices they were fetching at auction. For example, plot C447, close to the city outskirts, saw an over 500% increase in property price between September 2024 and February 2025. In roughly the same time period, plot C136 across the other side of town saw its property price more than double from $18 to $45. Plots C088 and C089 in the city centre were sold for $284 in a private sale, representing a 769% increase from its previous price in June 2024, and as recently as early March 2025, a listed commercial building sold for an eye-watering $820 at auction. So why had the commercial real estate market seen such an astronomical increase in property prices? Funnily enough, it could partially be my fault. After I published my video on virtual democracies, DemocracyCraft, along with several others mentioned in the video, saw a substantial increase in the number of new players joining. This so-called troligarch wave led to the creation of many small and medium enterprises, SMEs, the growth of which was fueled by heavy government subsidies with a budget of nearly $450 a month. According to Vaultbank CEO Xing X, these new SMEs had significantly driven up demand for commercial mortgages. But prices had also risen because of constricted supply. According to a November 2024 report published by the then construction minister, just 9 players owned over 40% of commercial land. Sources across multiple sectors of the economy have expressed frustration at what they perceive to be a cartel of wealthy landowners artificially driving up real estate prices by refusing to sell their land at reasonable prices. However, it's not exactly clear to what extent land ownership is concentrated in DemocracyCraft, because the names of owners listed in the publicly accessible land registry, which the November 2024 report draws upon, isn't fully accurate. Let me explain. Land hoarding has historically been a well-known problem in DemocracyCraft. Over the years, lawmakers have introduced swathes of new legislation to regulate land ownership in an attempt to curtail the practice. The number of properties a player could hold was restricted by law, property taxes were set to exponentially increase for every property held, and landowners were required to log in on the server for at least 6 hours a month to retain their property. In theory, these laws are meant to make land hoarding both expensive and cumbersome. In practice, however, it has spawned an entire industry dedicated to helping landowners circumvent these regulations using what's known as a trust. In short, a trust is created when a landowner pays another player to hold their real estate properties on their behalf. This player, known as the trustee, is tasked with meeting the playtime requirements to keep possession of the land and to pay any relevant property taxes. Since the trustee is the one that's actually holding the land registry will name the trustee as the owner of that property. However, legally speaking, the property is still owned by the original landowner, known as the beneficiary, who can, at any time, dissolve the trust and take their land back. Companies such as Elite Real Estate and Vaultbank have offered trustee services to their clients, with the latter even providing insurance in case the trustee loses control of the property. However, there's a debate over the legality of these trusts, and the debate circles around how property tax is defined under the law. Under Section 13 of the Taxation Act 2019, the law states, 1. Property taxes shall be calculated using a formula where X is the amount of plots a player owns and Y is the amount taxed per day. Taxes will be rounded down to the nearest cent. 2. Players shall not be taxed for property tax if they own 3 or fewer plots. What does own mean in this context? Does it mean the trustee, the person who's the registered owner of the property on paper, or does it mean the beneficiary, the person who actually owns the property and who can take it back at any time? Because if it's the former, which the companies offering trustee services would undoubtedly argue, the introduction of trusts would represent one of DemocracyCraft's greatest innovations in tax planning. A player with 75 plots of land could reduce their tax bill of $375 a month to just $11 a month by simply having 2 trustees hold 25 plots each. However, if it's the latter, and it turns out that this is technically illegal, then the industry may face a reckoning for potentially facilitating hundreds, if not thousands of US dollars worth of tax evasion. In any case, the real estate market is likely to face significant challenges on the horizon. Land reform has been a particularly hot topic for the political left, whose supporters, many of whom having joined during the so-called Troligarch wave, have expressed frustration over the inaccessibility of the property ladder. Recent election victories for the left have already ruffled feathers within the financial sector, and the election of a left-wing president, whose party has pledged to promote collective land ownership, has not allayed any fears. All it would take is for a few wealthy landowners to panic sell their land to swamp the real estate market with commercial properties, bringing down prices. The real estate market may not even need to wait that long. As was previously mentioned, the tightening of monetary policy could dry up liquidity within the economy. If wealthier players or companies are exposed to risks elsewhere and need cash fast, they may end up being forced to liquidate their assets. General economic downturn, meanwhile, could end up being the final straw for many SMEs who have already struggled to keep pace with the impacts of high inflation. A potential increase in mortgage defaults by SMEs could further swamp the real estate market with even more commercial properties. And if that happens, perhaps the real estate market was destined to be a bubble, waiting to be burst. By far the largest beneficiary of the Fed's monetary policies has been Redmont's over $100,000 financial sector. Composed of banks, private equity firms, and a privately run stock exchange, the financial sector has traditionally benefited from an incredibly generous tax regime, where depositors and investors are given a complete exemption from corporate and wealth tax. Over the past year, the server has seen a rapid consolidation of its financial sector. In the private equity space, Uffizi Holdings, notionally worth $34,000 in January 2025, have practically gobbled up all of its competitors through an aggressive strategy of mergers and acquisitions. In the banking space, a wave of collapses and closures have led the sector to be dominated by a small handful of companies. And this has caused a problem, because it has created financial institutions that have become too big to fail. Many financial investments, for example, are tied to the fate of these companies. In late January 2025, the Fed governor revealed that 90% of the Fed's investment securities, worth around $10,000, were in the shares of just one company, Uffizi Holdings, the owner of Volt Bank. When the media conglomerate Virtus Group was forced into bankruptcy, a company which made up 5% of the Fed's portfolio, the governor said in an interview that Virtus Group's bankruptcy isn't a huge threat to our balance sheet. If this were to happen to Uffizi Holdings though, then fuck. The F10K index, an index roughly analogous to the FTSE 100 or S&P 500, has over 50% of its portfolio in Uffizi Holdings stock, and an additional 35% of it is in the now bankrupt Virtus Group and its delisted subsidiaries. The financial sector is also deeply interconnected with each other. According to Volt Bank's accounting records, nearly $10,000 of its cash reserves were held in other banks during the first quarter of 2025. Vanguard National Bank, also known as Discover Bank, held over $5,600 in other banks. The CEO of Voyager Bank revealed in a February 2025 interview that it had around $4,000 of consumer deposits stored in Vanguard and another $1,000 in Volt. What this means is that the fate of the entire financial sector is dependent on the fate of these systemically important financial institutions. If one of them is allowed to fail, it could take down other institutions with it, creating a full-blown financial crisis. The issue is that DemocracyCraft's financial sector has faced incredible pressure from consumers who have made two competing demands. On the one hand, cash-rich consumers, benefiting from the massive flood of cheap money, have demanded higher and higher returns for their investment. The introduction of new disruptors attempting to challenge the traditional oligopoly, such as Voyager Bank, which has offered depositors interest rates as high as 5.5% a month, have only upped the ante for both pre-existing banks and new disruptors, forcing the financial sector to take greater and greater risks. On the other hand, the financial sector only survives if it has the confidence of its consumers. If consumers are worried about the risks that these institutions are taking, they'll simply take their money and run. And if a sufficient numbers of consumers panic, boom, you have a bank run. The financial sector has responded to this pressure in different ways, but we're increasingly seeing financial institutions throw governance, risk management, and compliance out of the window. Consequently, there's been a myriad of scandals that have hit the financial sector, and it has pushed consumer confidence to its absolute limits. We could be here all day talking about these scandals, so just to give a brief whistle-stop tour, you have Artrides Bank, which collapsed in June 2024 after its owner had gone missing for 2 weeks. Poor governance practices meant no one working in the bank had access to the bank's money, which meant that depositors were unable to withdraw their money, leading to its eventual bankruptcy and nationalization. You have Avalon Bank, which collapsed in late 2023 after its owner was accused of embezzling over $2,000 of taxpayer money. According to the Fed governor, its inability to keep up with its 5.5% a month interest payments, along with poor risk management and record-keeping practices, meant that its bankruptcy was all but an inevitability. The history of banks struggling to keep up with 5% a month interest payments has sparked fears within the industry about Voyager Bank's 5.5% interest rate. One banking executive, for example, reportedly joked about depositing $4,000 in Voyager just to see how long it could sustain the $200 a month interest payments. In a February 2025 interview, Voyager's CEO said that they had the startup capital to burn cash for the next 10 months, giving it time to develop vaguely defined technology that would supposedly bring money in the long run. The skepticism this has engendered can be summed up with a paper news article which asked, "Technology-driven banking, PR bullshit or a game changer?" You have Uffizi Holdings, which had its $34,000 market cap put under severe strain after the Fed attempted to dump $10,000 worth of Uffizi shares in mid-January 2025. When the Fed struggled to sell any of these shares, even after writing off $500, its governor said in an interview, "I couldn't and I still can't figure out who to sell the position to, since no one wants it. Some people believe the company is overvalued and is going to crash and burn." Smile emoji. Meanwhile, at about the same time, its subsidiary Volt Bank had suffered an apparent data breach when a list of its customers, IDs, and bank account details was stolen. According to one source who spoke under the condition of anonymity, that list was leaked to an insider working for a rival bank, leading to allegations of corporate espionage. We could go on and on and on. Ultimately, the strength of DemocracyCraft's over $100,000 financial sector is only as strong as its weakest link. As we've seen, there are many contenders for who that weakest link might be. Many in Redmont's financial sector, however, fear for the health of one specific institution, Vanguard National Bank. The systemic problems that have plagued Vanguard National Bank are an open secret among the financial sector. As DemocracyCraft's sole multinational bank, with over $33,000 in assets across multiple servers, according to its January 2025 accounting records, its difficulties with governance, risk management, and compliance have really been put under scrutiny over recent months. With respect to governance, it's perhaps misleading to use the term Vanguard National Bank in the first place, because it implies that the bank is run by multiple people. 3 current and former Vanguard executives have indicated that the bank is almost entirely run by its CEO, Nexlin. When I asked the governor of the Fed, who also served as Vanguard's IT chief, whether there was any other person that ran Vanguard or was otherwise familiar with its operations, he replied, only Nexlin. There's potentially a benign reason for why corporate power is so concentrated within the bank. As many sources within the financial sector have suggested, the server has historically struggled to attract players with the relevant expertise to work for the banks, particularly because DemocracyCraft often attracts young players who join for the politics instead of the economics. Centralizing corporate governance in the hands of one person, however, creates significant operational risks. For example, Vanguard has developed the unfortunate reputation for slow and poor customer service, particularly when it comes to withdrawing one's money. In September 2023, Starlight News reported that Nexlin berated one of his clients for making a simple inquiry on how long their withdrawal of $170 was going to take, reportedly telling the customer, "Shut up, we gotta verify shit first," and "You have turned down my bank consistently, I don't give a fuck." In October 2024, Stoppers, writing for Redmont's Business Insider, wrote that Vanguard's CEO has been a bit inactive lately, and customers are feeling it. it has led to tons of complaints about slow withdrawals and support tickets piling up. This problem hasn't just been confined to Vanguard either. In a February 2025 lawsuit, the then President LCN sued Nextlin's Blazora Corporation for defaulting on 2 months' worth of interest payments to bondholders. In court filings, the president alleged that they and their lawyers tried to contact Nextlin at least 4 separate times over 2 months before taking the case to court. Even during the course of this video's production, Nextlin had failed to respond to at least 5 separate requests for comment made between the 14th of January and 22nd of February 2025. The only responses I received were notices from his Minecraft lawyers saying that they were going through my inquiries to ensure Vanguard's interests were maintained in this documentary, as well as a response from Nextlin on the 26th of February stating that he would send his answers within the next 24 hours, which he didn't do, and a response on the 28th of February stating that he would send his answers that day, which he also didn't do. This reputation for poor customer service hasn't gone unnoticed by Vanguard's competitors. For instance, according to Vault Bank CEO XingX, Vault had capitalized on Vanguard's reputation by hiring a fairly large team of staff to run the bank, allowing for fairly quick communication with Vault's clients. The bank's one-man operation, however, doesn't stop it from having a complex corporate structure. Vanguard & Co., the bank's parent company, owns 2 other subsidiaries, including Vanguard Market Access, which offers its brokerage services, and Vanguard Asset Management International, which offers, among others, Forex trading. The bank itself is divided into several subsidiaries. There's Discover Bank, which is for regular clients, and there's Vanguard Private Bank, which is for higher net worth individuals, and that doesn't even include all of the other offshore subsidiaries that the bank owns. When I asked Stoppers why a bank would structure itself like this, he posited that it could make it harder for the bank to be regulated by the Treasury or the Fed. For example, if Discover Bank was sued in court, the assets held by Vanguard Private Bank would be protected as a supposedly different legal entity. This brings us to the bank's attitude towards legal compliance, which have invariably been shaped by Nextlin's reckless disregard for the law. Those weren't my words, by the way, those were the words of Judge Dartenboy, who, in the previously mentioned Blazora lawsuit, found Nextlin guilty of contempt of court. In a judgment handed down in late February 2025, the court ordered Nextlin's Blazora Corporation to pay damages for market manipulation, misleading and false advertising, breach of contract, 5 counts of misrepresentation, and 5 counts of fraud. In a substantially more serious case involving the bank, in mid-January 2025, Vanguard was accused by CityRP staff of allowing nearly $6,000 worth of illicitly obtained CityRP dollars to be laundered through the bank's currency exchange. Between the 15th and 20th of January 2025, a user by the name of Laudaleo, who, by the way, would form Voyager Bank after this incident, deposited nearly 14 million DemocracyCraft dollars worth of CityRP currency that was illegally obtained through duping. Laudaleo subsequently converted this currency to DC dollars and was accused by regulators of attempting to dispose of them using DemocracyCraft's real money trading markets. In statements given to CityRP staff, Laudaleo denied that he laundered the money for monetary gain, stating that he wouldn't need the money anyway as he was supposedly the richest person on DemocracyCraft. Instead, he stated that, as a security researcher, he was simply testing bugs on the server. He claimed that his deposits and back-and-forth currency transfers were done to prevent the wholesale collapse of DemocracyCraft and CityRP's banking systems. In a subsequent March 2025 interview, Laudaleo explained that he had done this out of anger, as he felt his contributions to the server had been taken for granted. He said that the laundered money was eventually returned to CityRP and that none of it was used by Voyager Bank. During our interview, Laudaleo expressed surprise at my questions, stating that he and Nextlin had agreed to keep the incident a secret. He inquired who my sources were, which I declined to answer. One CityRP source familiar with the matter has claimed that Nextlin denied any knowledge of the money's provenance, but the incident raises serious questions about the bank's compliance practices. According to transaction logs obtained by regulators, over 75% of the bank's deposits between the 14th and 27th of January were from one person, Laudaleo, who deposited more money than the DemocracyCraft government had in reserves. Why weren't any red flags raised earlier? Was this a case of negligence, or was this a case of willful blindness? There are many other incidents that Vanguard has been involved in that have put the bank's compliance practices into question. For example, Laudalio has accused Nextlin of using his graphic designs in early March 2025 without his permission. When Nextlin was confronted about this, Laudalio claimed Nextlin had threatened to sue him. But I'll turn to one final point about legal compliance. In February 2025, I approached CityRP's finance minister with a simple question. In its regulatory filings, Vanguard declared it had zero taxable profits for 2 months in a row, but its own accounting records appear to show a very different story. Could you please help me understand why there appears to be some sort of discrepancy? Registered banks in DemocracyCraft are exempt from corporate tax. Instead, they have to pay what is known as a financial institutions tax, which is a 20% tax on monthly reported profit. According to Vanguard's leaked accounting records, the veracity of which was corroborated by 4 separate sources with access to them, including bank insiders and regulators, the bank made over $2,000 in pre-tax profit between November 2024 and January 2025. While these figures encompass Vanguard's global revenue, meaning that it includes profits made in other Minecraft servers, we know that a vast majority of it was likely made in DemocracyCraft. For example, Vanguard's balance sheet for the month of December 2024 indicated that it had around $10,400 worth of cash reserves worldwide. Based on the bank's internal records, such as regulatory filings and transaction logs, along with information gathered from government sources across CityRP, BusinessCraft and Harlan, we could work out that over 95% of it was in DemocracyCraft, corroborating one estimate given by a former Vanguard executive that around 95 to 99% of the bank's income came from DemocracyCraft markets. Assuming, generously, that 90% of the bank's operations were done in DemocracyCraft, Vanguard should have paid $367 in taxes between November 2024 to January 2025. However, if we compare those figures to the total tax collected by the Treasury for all registered banks, not just Vanguard but Volt as well, we can see that the figures don't add up. At least $275 of taxes appear to be missing from the Treasury's coffers, and that figure assumes that Vanguard was the only institution to pay the tax, which it wasn't. So here's a question: where did the money go? Stoppers, who is both a Vanguard executive and governor of the Fed, said that he had no idea because he had never filed the bank's taxes before or handled them. Instead, he simply remarked that he wasn't sure if the banks were honest when reporting taxes in the first place. Government sources across multiple servers, meanwhile, have indicated that they either have zero idea where the money went or wouldn't have access to that information anyway, owing to bank secrecy laws. What we do know is that, as a multinational company, Vanguard has to deal with something that many other businesses don't: international tax law. Suppose you're the owner of a bank that has branches in both DemocracyCraft and CityRP. Users can deposit and withdraw their money in either branch, and their deposits are recorded in a central database managed by the bank. By joining the bank's Discord server, which both DemocracyCraft and CityRP players have access to, users can access the bank's Discord bot, which allows them to instantly check their balance and transfer money to anyone else with a bank account. If a user wanted to exchange their DC dollars for CityRP dollars or vice versa, they could use a Discord bot to do so, and in return, they would be charged a 5% commission fee. So here's a question: on what server did the bank earn its commission? In many cases, the question has an obvious answer. If you ran a chicken farm in CityRP, you obviously made your income in CityRP. But the Forex transaction physically happened in neither Minecraft server. It was done on a privately owned Discord server. This question is important, because both DemocracyCraft and CityRP have taxes on registered banks, and they don't recognise each other diplomatically. From a DC regulator's perspective, the commission was earned on DC soil, as CityRP doesn't exist, and thus would be subject to the 20% tax. From a CityRP regulator's perspective, the commission was earned on their soil, because DemocracyCraft doesn't exist, and thus it would be subject to its 25% tax. This is known as the problem of double taxation, when 2 or more jurisdictions try to tax the same income. So how do you resolve this problem? Well, we know that double taxation isn't absolute. If a user played on both Minecraft servers and ran a business in each of them, a chicken farm in CTRP and a mining company in DC, you'd be hard-pressed to argue that the chicken farm was liable to DC corporate tax, particularly because, under DC law, CTRP doesn't exist. So we know there's a line to be drawn somewhere that separates taxable income from tax-exempt income. We just don't know where the line is because the tax laws are ambiguous. But where there's ambiguity, there are loopholes. And where there are loopholes, there's international tax planning. If we go back to the Forex example, you could approach the problem in 3 different ways. You could choose to play it safe and voluntarily pay double taxes. But you could also lawyer up and stand your ground, insisting that one set of transactions was done in DemocracyCraft and another set was done in CityRP. That way, both servers get a cut of the taxes. But if you could do that, why not go further and declare that both sets of transactions were done in DemocracyCraft? After all, DC has a lower tax rate than CityRP, and so by reframing the transactions as being done entirely in DemocracyCraft, you essentially shifted your taxable profit from one server to another. This is known as base erosion and profit shifting, BEPS, when you shift your taxable profit from a place with higher taxes to a place with lower or no taxes. And if you're using BEPS, you can do some truly magical accounting. Why stop at 20%? Harlan, for example, is a server that has many advantages. It's incredibly easy to register a company with, it has no monthly disclosure requirements, and its regulators are half asleep owing to their chronic understaffing issues. Most importantly, its tax rate on profit is 0. So what if you changed your bank's operations a bit and made it no longer possible to convert between DC and CityRP dollars directly, but instead forced players to purchase or sell an intermediary currency like the Harlan pound? That way, you and your Minecraft lawyers could argue that all of the bank's Forex transactions were done in Harlan, and thus would be subject to its 0% tax. And congratulations, you've just used an offshore tax haven in Minecraft. The magic of BEPS is that it doesn't just have to be confined to ambiguous income sources, it can be used to reduce taxable profit that was clearly earned on one server. Suppose your bank's DemocracyCraft branch earned 2 million DemocracyCraft dollars in pre-tax profit. If you were to pay the full amount of tax on that, you would have to pay 400,000 DemocracyCraft dollars to the Redmont Treasury. But recall that profit is defined as revenue minus expenses. Under Section 7B of Redmont's Taxation Act, profits are the earnings a financial institution keeps after all operating costs are paid. If you can't shift your revenues around, what you can do instead is increase your expenses. BusinessCraft is the perfect server in this regard. As the archetypal tax haven in Minecraft, it has no corporate tax, income tax, wealth tax, property tax, profit tax, or any sort of tax treaty with CityRP or DemocracyCraft as of February 2025. Better yet, it has virtually no regulations on banks. There's one questionably enforceable executive order requiring private banks to register, and that's it. There's no need to declare shareholders, no need to declare monthly income, no need to submit paperwork to regulators on a monthly basis. Firstly, set up a subsidiary in BusinessCraft and transfer the ownership of your bank's Discord bot to this new subsidiary. Secondly, strike a deal between your DC branch and BusinessCraft subsidiary to license the rights to use your Discord bot. How much would that cost? Well, you own both companies, right? So go wild! Let's say, for this example, you set the price at 1.9 million DemocracyCraft dollars, simply because reporting 0 taxable profit would likely invite unwanted attention from regulators. And voila! By using your Discord bot as a BEPS tool, you managed to turn $2 million worth of taxable profit to $100,000, reducing your tax bill to just 20,000 DemocracyCraft dollars. As BusinessCraft has no profit tax, the other 1.9 million is safely in the hands of your BC subsidiary. But the money is no good being stuck in DemocracyCraft. After all, you're just using it as an offshore tax haven, and you don't plan on doing anything else there. So you're going to need to move the money back to DemocracyCraft. How do you do that? Easy, just set up a bank account in DemocracyCraft for your BC subsidiary. Your subsidiary's bank account doesn't even have to be with your bank. and in fact, it may be wiser to set one up with a rival bank to make it harder for regulators to trace where the money is, and to earn a bit of interest while you're at it. As the DemocracyCraft subsidiary is not a registered bank in DemocracyCraft, it doesn't have to pay the 20% financial institutions tax, and as there's no tax on importing money offshore, you can move the full 1.9 million DemocracyCraft dollars back into DemocracyCraft tax-free. As you still control the BC subsidiary as its owner, you can direct the subsidiary to spend that money, which is now in DC, in whatever way you wish. According to DemocracyCraft's Deputy Finance Minister Avinish 2008, Vanguard's declared profit to the Treasury was roughly a tenth of what its own income statement suggests, implying that it avoided around $330 worth of taxes between November 2024 to January 2025. The only way that could have been done legally is if Vanguard had made significant use of international tax planning, including the use of offshore tax havens. Multiple sources familiar with the matter have indicated that outright tax fraud is the more likely explanation. Jack, who served as Vanguard's operations chief in CityRP until mid-December 2024, said in an interview that the bank didn't make any use of international tax planning strategies during this time. Any tax strategy developed would be after my tenure, he added. Another source, who spoke under the condition of anonymity, claimed that Nexlin used the bank's income statements, which indicated monthly pre-tax profits of over 1 million DemocracyCraft dollars, to court new investors. They alleged that Nexlin's accountants created separate fabricated income statements to intentionally underreport the bank's income, thereby reducing the taxes they paid to the Redmond Treasury. After being presented with these findings, regulators for both CityRP and DemocracyCraft independently stated they were launching investigations on the bank for suspected tax fraud. In response to its CityRP tax probe, the bank told regulators that it declared zero taxable profits for 2 months in a row because its interest expense outweighed its revenues in CityRP. How those values were calculated were not disclosed to the regulators. In an interview given in mid-February 2025, BusinessCraft's finance minister, Len Tark, stated that Vanguard National Bank was not a registered bank on the server at the time, suggesting that the bank's Forex transactions in BusinessCraft could be a violation of its banking registration rules. In Harlan, Finance Minister Yoshipai said in an interview that Vanguard National Bank, which has been registered with its finance ministry, had been inactive on the server since June 2024. According to Harlan's Justice Minister Nish Ghai, it's unclear whether the use of its server as an offshore tax haven would be illegal under its own laws. Regardless of legality, Nexlin's decision to play fast and loose with taxes is a dangerous game. But playing this dangerous game is perhaps symptomatic of Vanguard's risk culture. We've talked about governance, we've talked about compliance, so now it's time to talk about risk management. Banks have to take financial risks. If they don't take risks, they don't make money. The medium-sized Bank of Rayville, BOR, tries to be an exception to this rule by foregoing the need to make any money. Advertising itself as a boring bank, BOR doesn't pay its depositors any interest, and thus it doesn't need to do any investing at all. In a February 2025 interview, its bank director Taylor said that the bank makes 100 DemocracyCraft dollars per withdrawal, a fixed $100 as a bank startup fee, and that's it. Its business model has led one financial industry veteran to say BOR is confusing because it offers no benefits to depositors. It doesn't really operate as a business, and it doesn't do bank-like things. The only benefit it does give is that it offers depositors a way to avoid corporate and wealth tax, which one news outlet precariously described as legal tax evasion in July 2023. Former BOR co-founder Lil Digivert put it more bluntly. In a February 2024 interview, he said the bank was made as a place for people to tax evade. Ironically, BOR's total aversion to financial risk exposes it to a different type of risk: regulatory risk. In July 2024, the bank was charged by prosecutors in a now-dropped case of being a tax haven disguised as a bank, a claim which the bank has strenuously denied. For the rest of Redmont's financial sector that takes a degree of financial risk, one of the most common complaints has been the lack of viable investments on the server. As the Fed Governor Stoppers put it, There are no capital-intensive businesses like manufacturing, so a lot of rich players, banks and businesses just have piles of money sitting around with nothing much to do with it. This lack of things to spend money on is my biggest problem with DemocracyCraft personally. The issue could be because of hyperinflation, however the wild has a huge part to play with this. Minecraft's mechanics aren't particularly hard at all, so it's very easy to harvest resources. This results in a stack of chicken costing like a DemocracyCraft dollar. Anyone can set up a chicken farm and become self-sufficient. With banks and investment firms having to make money somehow, the industry has had to get creative. And perhaps there was no greater pioneer of industry creativity than former DC financier Jack, the same man who invented the Onyx-backed credit obligation back in 2022. To put it in his own words, "I'm often not proud of what I created. I feel largely responsible for turning DC finance into gambling. But that's fun." Yes, very fun. The creation they were referring to? Echo Securities. An Echo Security is a contract that a user can buy from a bank that essentially mirrors or echoes the value of a stock in real life. For example, if you wanted to buy 100 Echo Securities in Apple stock, the bank would check the price of the stock in real life, let's say it was $200, and then sell those Echo Securities at that price. In this case, $200 times 100 gives you 20,000 DemocracyCraft dollars. But why would you ever want to buy an Echo Security? After all, it doesn't allow you to own part of the company and it doesn't pay any dividends. The catch is that you can sell the Echo Security back to the bank at any time for the current market rate. So suppose the price of Apple stock increased to $250. You can sell your 100 Echo Securities back to the bank for 25,000 DemocracyCraft dollars, making $5,000 of profit in the process. Essentially then, Echo Securities allow the financial sector to bet on the price of real-life stocks and assets. If the price of a stock goes up, the purchaser wins. If the price of a stock goes down, the bank wins. The key issue with Echo Securities, however, is that the risk taken by the parties is uneven. Suppose you purchase 100,000 DemocracyCraft dollars worth of Echo Securities. If the underlying company went bust, you can lose at most $100,000. If the underlying company, however, does extremely well, the bank could lose way more than $100,000. In fact, as there's no limit to how well a company can do, the bank's losses, by holding a short position, can theoretically be unlimited. The financial sector has attempted to address these risks in two different ways. Firstly, it has transformed the Fed into a casino. As an institution that can just print more money, it's the only one that could actually afford to pay out theoretically unlimited losses, and by December 2024, it had sold over $7,500 worth of Echo Securities. As Technofeed put it, historically, the Fed has had a focus on macro policy, namely inflation and deflation, but these days it seems more fixated on securities and trading. As financial institutions are the only ones that can buy Echo Securities from the Fed, several sources have described the Fed's Echo Securities program as being nothing more than a cash grab for the sector. When the Fed reported it had made around $4,000 worth of losses in January 2025, the Fed governor explained that it was primarily because they were forced to purchase back their securities at a huge markup. Secondly, financial institutions have traditionally employed human players to oversee Echo Securities trading. Vault Bank, for example, employs bankers that can sell Echo Securities to its clients. Importantly, because there's a human in the loop, the bank can simply say no if the proposed deal is too risky for the bank. Enter Vanguard National Bank. As a bank that is practically run by just one person, it can't go around dispatching its CEO to fulfill hundreds of buy and sell orders for the bank's Echo Securities. So what does the bank do? It relies on technology. Vanguard Market Access is a brokerage platform that allows players to buy and sell Echo Securities at a click of a button. The transaction is instant and requires no manual approval. The bank, by selling these Echo Securities, essentially shorts whatever stock or assets its customers please and at whatever quantity they desire. Xing X, Chief Operating Officer of Vault, defended market access, arguing that from his experience, DemocracyCraft's players, many of whom are young and inexperienced, often trade riskily and poorly, allowing the bank to pocket their losses. But it's precisely the fact that players are making risky trades that exposes the bank to high financial risks, and it didn't take long for the bank to suffer substantial losses after a trader had apparently purchased Melania CryptoCoin Echo securities on their platform. Echo securities aren't even the riskiest thing that Jack has brought to the world of Minecraft finance. The prize for that, arguably, goes to the synthetic loan. For most of DemocracyCraft's history, the financial sector has struggled to give out enough loans. Sources across multiple banks, including Vault, Voyager, and Vanguard, have indicated that players seem completely uninterested in taking out loans in general. Xtub, former chief operating officer of Vanguard, attributed this lack of demand to the Fed's incessant money printing, which has made everyone cash rich, and the Treasury's business subsidies, which have reduced the need for commercial loans. Demand for loans within the financial sector, on the other hand, was and still remains very high. Perhaps there's no better example of this than Royal Ace Casino's announcement in February 2025, which stated that the casino was offering game loans for aspiring gamblers with a good track record of winnings. Eligible borrowers may borrow up to 2 times their current net worth, which will be secured by their collateral at an interest rate of 7.5% a week. So how do you reconcile the high demand for loans while having such a short supply? To put it in Jack's own words, you magnify the nominal risk reward of existing credit markets and make a $100,000 market big enough for $10 million investors. Let's say your bank has given out 5 $10,000 loans at a 20% simple interest rate to various players. For 4 months, these players make monthly repayments, paying off a quarter of their loan along with interest. If every player paid off their debt, your bank would make 10,000 DemocracyCraft dollars of profit in 4 months' time, and if you wanted to, you could just leave it at that. Alternatively, you could package these loans into a credit-backed security, CBS, and sell that to investors instead, for example, $55,000. Now, instead of repaying the bank, the players are repaying the investors of the credit-backed security. Why would you want to do this? In short, loans are a risky business. A player could default on their Minecraft house mortgage simply by leaving the server and never playing DemocracyCraft ever again. By selling the loans in a CBS, a bank can effectively pass this financial risk onto investors and still leave with some profit. But a CBS with a notional value of $24 isn't exactly exciting to investors. So what can you do to make it more exciting? You can create what is known as a synthetic loan. Let's take a look at one of the original loans. A player, let's say a small shop owner, had taken a $10,000 loan to expand their business operations. You can sell a $300,000 synthetic loan on top of that to investors. If the shop owner successfully makes a repayment, a quarter of the $10,000 loan with interest, the bank would also make a repayment, a quarter of the $300,000 synthetic with interest. But if some tragedy were to somehow befall the small shop and the owner defaulted on their loan, the synthetic loan would collapse as well, meaning that the bank would no longer have to make any more repayments. Essentially then, synthetic loans allow the bank and the investors to make bets on whether the original debtor can pay back their loans. If the shop owner pays back their loan, the investors can earn a small profit from the interest of the $300,000 synthetic. However, if the shop owner defaults on their loan, the bank can earn a massive profit, earning the full $300,000 if they defaulted on their first repayment. By packaging these synthetic loans into the original CBS, you could balloon what was originally worth a notional $24 to over $750. Except now, instead of losing around $15 if 3 players defaulted on their loans, the investors would lose over $450. If you're thinking, this sounds a lot like the synthetic CDOs that were involved in the subprime mortgage crisis, you're not alone. Omega Beeble, the CEO of Alpaca Capital, said in an interview that Jack bakes some dangerous shit, real 2008 synthetic CDO vibes sometimes. Financial investor Luke the Great simply posted videos of The Big Short when I asked him what a synthetic loan was. But do you know who loves dangerous shit? That's right, Vanguard National Bank. According to records held by Jack, in early 2024, Vanguard's $500,000 DemocracyCraft dollar stake in a nearly $1.4 million CBS blew up after 2 out of the 4 original loans failed. one player defaulted on their $10,000 loan and the other on their $2,500 loan, sparking the collapse of over $1 billion DemocracyCraft dollars worth of synthetic loans. Vanguard's history of taking needlessly reckless financial risks indicates severely deficient risk management, assuming you could argue it even bothers with it. Arguably, it's this propensity to take dangerous risks that has made Vanguard National Bank into the $33,000 behemoth that it is as of January 2025. But past performance doesn't guarantee future results, and with the enormous risks the bank is exposed to, all it takes is one crucial misstep for all of it to come tumbling down. When investors are scared of the future, they begin to look for exit options. In late 2020, a notional $30 million was wiped out from the global Habbo economy after investors panic sold their assets and currency on the black market. The fire sale was in response to a series of announcements, including the introduction of an 80% wealth tax, a 400% increase in exchange tax, and a nearly 6,000% increase in sales tax. Historically, investors that wished to liquidate their position from DemocracyCraft only had one option: the black market. If you needed to dump hundreds of US dollars worth of DemocracyCraft currency, you couldn't exactly do that in the public auction channels, the grey market. Multiple sources familiar with the black market suggest that the exchange rate for large quantities of DC dollars is substantially higher than in the grey market, with rough estimates hovering at around 5,000 DemocracyCraft dollars per US dollar. Bearish investors were thrown a lifeline when Vanguard National Bank introduced QuickPay. With a simple click of a button, the bank's clients could convert as many DC dollars as they wished for currency on a different server. Like with market access, there was no human in the loop. The bank was offering carte blanche access to its foreign currency reserves, and all of that for a small fee. So what was the exchange rate? For CityRP, Nextland set a fixed exchange rate at 10 DemocracyCraft dollars per CityRP dollar, a rate which immediately attracted the attention of investors. As one put it, at the time, DC looked to be in its end-of-life stages, where the government of the server had fallen far behind the private sector, to the point that it was becoming normal for companies to overtake the actual government in value, coupled with politicians who did not understand or care for the private sector that was overtaking them. As such, when the opportunity opened to escape to a new server with better staff and a chance to start again without all of the current issues with the government, while maintaining their personal wealth, practically all major finance players tried moving their fortunes to this new promised land. Investors began speculating amongst themselves about what the exchange rate ought to have been. Exchange rates of 20 to 1, 30 to 1, and even 100 to 1 were cited. In an interview given in mid-January 2025, the Fed governor defended the 10 to 1 rate as pretty fair, only to revise his assessment just 5 days later in a different conversation. While there was disagreement among the financial sector on the true value of the DC dollar, there was little disagreement that Nextland had made a huge mistake. In the alleged words of insiders within CityRP's governing party, Vanguard had overvalued the cheap, overinflated clusterfuck Redmont dollar, and players were going to take up the bank's offer in droves. Currency traders began aggressively shorting the DC dollar, dumping over 2 million DemocracyCraft dollars by January 2025. The speed at which traders were dumping the dollar clearly took the bank by surprise, because its CityRP branch quickly went insolvent. Jack, who worked as Vanguard's head of CityRP operations, said the bank rapidly gained a reputation in CityRP for its inability to cover withdrawals and for being insolvent. Few people chose to bank with Vanguard after that because of fears of not being able to get their money out. The bank's liquidity problems led to CityRP's stock exchange suspending payments from QuickPay, and according to messages from Nextland himself, the bank eventually had an estimated backlog of over 1 million DemocracyCraft dollars that it couldn't pay out to its customers. According to Luke the Great, who was CityRP's finance minister at the time, he and stoppers urged Nextland to abandon the fixed 10 to 1 rate and adopt a variable one instead. There wasn't exactly a bank run in VMB, but it was becoming a slight worry, stoppers observed. But despite having plunged the bank into insolvency, Nextland didn't budge. He kept the 10 to 1 rate and kept the exchange going, a decision which two sources familiar with the matter described almost as a form of denial. Thus, the bank confounded all expectations when it not only cleared its withdrawal backlog, but managed to report to regulators it had excess bank capital by January 2025. According to Jack, who by then had resigned from Vanguard to become CityRP's finance minister, the bank was short around 500,000 to 600,000 DemocracyCraft dollars the day before their filings, suggesting that the bank had struck some sort of last-minute deal to stay afloat. By February 2025, the bank's excess reserves in CityRP had grown to a healthy 1.8 million DemocracyCraft dollars in CityRP currency. By sticking with the 10-to-1 rate and fulfilling all of its Forex transactions, Vanguard had done what appeared to be impossible. It had defended the currency. In doing so, it managed to defend the value of not only its own assets in DemocracyCraft, but the assets of every player and institution in Redmont. So long as it can guarantee the 10-to-1 rate, DemocracyCraft's economy can only fall so much. Then, in February 2025, the left swept into power. 1950 Minecrafter won the presidential election, representing a party that pledges to drastically increase government spending, strengthen trade unions, and collectivize land ownership. In just 17 days, Forex traders dumped nearly 9.4 million DemocracyCraft dollars, far outpacing the 5.8 billion that was bought. The capital flight from DC obliterated Vanguard's cash reserves. Its excess bank capital in CityRP fell from over 1.8 million DemocracyCraft dollars to just 93,000 by March 2025. The bank once again finds itself at a critical juncture. The short sellers have taken up Vanguard's offer to sell it as many DC dollars as they want, and they've raided its foreign currency reserves. But this time, they've upped the stakes, betting thousands of US dollars worth of virtual currency against the bank. Their bet is that Vanguard National Bank can't afford to sustain the 10-to-1 rate because the dollar is too weak, because the bank is too weak, because the economy is too weak. Their bet is that Vanguard National Bank would either have to depreciate the currency, suspend the Forex market, or collapse trying, causing a catastrophic Black Wednesday-style currency crisis to hit DemocracyCraft. Their bet is that if everything in Redmont comes crashing down, their virtual assets would be safe offshore in the tax haven of the Azalea Isles.